Welcome to How to Invest. Today we are talking about stocks that you need to avoid. A lot of people look for big winners. Most people don't know the way to actually get good results is to avoid really big losers. Big losers can take you out, and that's why this is a very important video for you. So my name is Jacob. This is my sister Abigail.
Hi, my name is Abby. This is part 4 of our series, Investing for Beginners.
Yeah, so I am here talking with Abby because I thought it would be a fun dynamic to teach to my actual sibling here instead of talking to a camera. I think it makes it more personable and helps you to understand. I'm literally teaching my sister how to invest at the same time and just recording it. So this is actually what I really feel. And that doesn't mean I'm gonna be right all the time, but a little bit of background on myself. I learned investing from Peter Lynch. He is my investing hero. He wrote a ton of good books. I really love this one up on Wall Street that teach everyday people how to invest better than Wall Street. And I gotta say, he succeeded at it because since I started investing after reading Peter Lynch, I have averaged over 70% annualized returns over my career. It's been over 5 years now. In the last 2 years, I have averaged over 100% annualized returns, which is crazy. Like actually doubling your portfolio 2 years in a row. It's been absolutely wild. And just, investing legend Peter Lynch, one of the best investors in the world, when he managed for Fidelity, he only averaged 29%. So watch this video because I'm going to teach you how to get 100% returns. Well, at least I'm going to teach you some stocks to avoid. So
teach what you learned, how you were able to get 100% returns, and hopefully help you do that as well.
So if I asked you, what do you think is a stock to avoid? Like what makes a stock to avoid? What would you say?
I would say maybe something that has been in the market for a long time and people are getting less and less interested in that product as a whole. For example, I work for David's Bridal. And we went through bankruptcy and I saw less and less people coming in the store. I would definitely not want to invest in a company like that because they're not doing so well.
Yeah. So a company whose fundamentals are struggling, where the revenue is struggling, the profit is struggling, they're not finding success anywhere, they're closing down stores. Yeah, that can definitely be a stock to avoid. If it's actually headed for bankruptcy, then you're not going to be getting a lot of great gains from it. However, on the flip side, and this is going to surprise you, the first reason that I'm going to give you of stocks to avoid, you want to avoid stocks that are all the buzz right now. You want to avoid stocks that everyone is praising, that everyone's talking about. Maybe the CEO of your company is on the cover of Forbes today, because normally when a company gets to that point, there's a ton of enthusiasm about it, and the sentiment can only get worse. Which means in the short term, you have a lot more room for downside from sentiment change. And even if you think the company is still going to do really well, maybe you can ignore this advice. I kind of ignored the advice a little bit straight from Peter Lynch with Tesla. I held Tesla even after it went from the hated child to the most beloved. Jim Cramer saying this is the best stock you can buy, which is that's the top signal I'm talking about here, where everyone loves it. People who have absolutely no real fundamental understanding of stuff is telling you that it's amazing. That's when you know, okay, sentiment can only get worse from here. So avoid the stocks that everyone is talking about.
Avoid the hype wagon.
Exactly.
Because they can. The only place they can go is down. That makes sense.
Yeah. So it's a bit of what you wouldn't think.
Well, it doesn't mean that you can't invest in that company later as hype cools down and the stock goes down, because you know that long term they're going to do good, right? That it just means that don't buy in right when it's getting at its highest peak, because you really can only hurt yourself.
Yeah, for sure. And it can, especially because this is a beginner's course, it can be really disheartening when you buy a stock and it goes down a lot. Yeah. Because you feel like you're not good at it, and even though it can happen to anyone. So just avoiding the stocks with all the buzz can be really good and help you avoid really big losses, especially as you're a beginner and just getting into it. So we'll be talking about this like good characteristics in the next video, but let's talk about another thing to avoid. Okay. We talked about it in a previous video. What's I don't want to put you on the spot too much, but can you think of another thing that I would say is?
I said if they're going bankrupt, and you said.
Well, so it
they're
actually
super
plays
hyped.
into this.
Yeah.
So stocks cannot go bankrupt if they don't have debt.
Mm.
So what the flip side of that, of what to avoid, is a stock with a ton of debt, with way more debt, and especially debt that's due in the near term, like debt that's maturing soon. And if they have way more debt than they have cash, then that can be a really bad sign. So actually looking at the balance sheet, avoid stocks with a ton of debt. There's a lot of very big companies that you think might be good investments, and because they're trading fairly cheaply, like a 12 price to earnings ratio or something, and then you look and they have literally billions and billions and billions of dollars of debt. So one thing that I think is really good to do is understand the enterprise value of a company. Oftentimes you'll see it just EV, enterprise value. The way that you calculate the enterprise value is you do the stock price, so what you're actually paying for it, the market cap, plus debt, because that's the actual price you're paying. Because if you buy a company that has a ton of debt, guess what? You now have that debt. You're buying that debt.
That doesn't seem so good.
Yeah, no, it's definitely not great. So it's market cap plus debt minus assets is enterprise value. So if a company has $1 billion of debt and $1 billion of assets, then the enterprise value is the same as the market cap is, the same as the company's valued at. But if a company is valued at $10 billion and they also have $10 billion more debt than assets, then the enterprise value, what you're paying, is really $20 billion, because you're also taking on that debt by becoming an owner. And even though it might look like it's a 12 PE, it might actually be a 24 PE, because it's twice as expensive as you think. So one example of this is I was looking at a bunch of tire companies, because I was like, it's like these tire companies are trading like 0.1 times sales, which is not profit, that's just revenue, but they have terrible profit margins. And then I look, and like a lot of them have billions and billions, like tens of billions of dollars of debt, because they're hundreds of years old, and they have very high expenses. So even though they're doing a lot of revenue and you see their tire in every car, I realized that this is not a good investment, because I'm actually paying way more than I thought, because they have so much debt. I'm literally buying years and years of bad management debt. A ton of bad decisions over and over again. So
I do have a question.
Sure.
Obviously, companies are going to have some debt, and that's okay. It just really depends on how much they're earning and how much debt, like you kind of said. If it's an old company and they've just continued to accumulate debt, that's bad. But a new company, it's really normal for them to have debt. They have to get started somehow, right?
Yeah. So there is a company that I just bought some of it today, actually. I'm planning on buying more of it, that does have a good amount of debt. It's only a $2 billion company, and they have like $1.5 billion of debt or something, but they have like $1.7 billion of assets.
Okay.
So they still have 200 million more assets than liabilities, which it's not great. You can obviously find better balance sheets than that. But the reason that I started buying it is because the last 2 quarters, they actually became net profitable. So they have gone from many, many years of losing money every single year. And when they went public, they actually raised $750 million. So they burned through that. And now they're only worth $2 billion multiple years later, when they raised $750 million of cash that they literally had. They burned through it. But now they've finally gotten to the point of profitability. So now that they're making money for the last 2 quarters, it just happened, they're going to start stacking more cash. They're going to be able to start paying off their debt. So the financial situation they're in, yes, they had to raise some debt in order to get to the scale that they needed to get to be profitable. But now that they're making profits, you can see their debt is going to start going down. Their cash is going to keep on growing. So it's understanding it in the context of the story.
Yeah, their whole situation, not just one piece of it, for sure.
Exactly. And if you haven't watched the video that we made on building a story, definitely watch that video. But yeah, avoid companies with a ton of debt is number 2. So we've gone through super hyped and a ton of debt. And we can throw in number 3, which is honestly the very first suggestion that you gave, which is a company with really bad fundamentals that's actually headed for bankruptcy. One thing that a lot of people say oftentimes, Peter Lynch talks about this, is really dumb, what they say. It's like, it's gone this low, it can't go lower. And that's something people said about Kodak, for example, which was a really big company that made all the stuff that people used to take pictures. Mm-hmm. And it fell and it fell and fell. Like, it's gone this low, it can't go any lower. But
bankruptcy.
But they went bankrupt because of the digital camera. Mm. And they literally invented the digital camera, but then didn't commercialize it because they didn't want to destroy their current business. So then other companies did the digital camera and destroyed the business for them. Which, is the innovator's dilemma. So that leads to the next type of stock to avoid. This is a really old company that you might view as safe, but that's being disrupted. Because being 100 years old, it doesn't mean that you're immortal. It means that you
could be at the end of your life almost.
Yeah, it means that you have a bunch of legacy systems that are now kind of a type of debt. When you're trying to integrate AI, for example, and you have 500 different systems that don't talk to each other, and it's because you've built up your company over hundreds of years and maybe made dozens of acquisitions. So everyone's using different software and computers and coding languages, and nothing talks to itself. So being really old, if you're being disrupted, can actually be a huge disadvantage. And then you look at the example of Kodak or even GM. GM made an EV tons of years ago and then discontinued it because they didn't want to disrupt the gas car business. And that allowed Tesla to exist. Tesla never would have existed if GM kept making electric vehicles.
Yeah.
So right now, I would say that an example of this is Legacy Auto. Their company is Ford has been around for 100 years and it's never gone bankrupt. And maybe it's going to succeed, but there's just so much risk because they're getting disrupted by a company that can make better cars for cheaper. And
with new technology.
Yeah, with new technology and full self-driving and all of this stuff. So avoid companies that are being disrupted. All right, so if you want to watch our full course, we're making an entire course on investing, going from zero to being better than Wall Street so that you can get incredible returns. That's not done yet. We're still working on it. But when it is finished, it will be linked in the description. And we'll have more videos in this series. Next up, great company attributes. So if you got depressed hearing about companies that you shouldn't be buying, then you'll like the next one talking about what should I be buying then?
Yeah.
All right. Thanks for watching. Thanks for sitting here and letting me talk with you. Do you have any questions from that you think people might have, or any thoughts before we end here?
No, I think it makes sense. You want to buy companies that are going to continue moving forward.
Yeah. And aren't in the top of a hype cycle right now.
Yeah.
All right. Thanks for watching. Drop a big thumbs up. Click the next video on the screen now, and you will learn all the things to look out for.